All right, today we're going to do a professional postmortem on the market cycle we've just been through. Now, this isn't just about looking back. Think of this as a case study, using hard data to figure out what went so wrong for so many investors. The goal? To help us all make profoundly better decisions from here on out. Okay, let's dive in.
We have to start right here with this number. It's just staggering. According to Delbar's analysis, the average investor underperformed the S&P 500 by almost 8.5% in 2024 alone. That is a massive, self-inflicted penalty. And believe me, this isn't a fluke. It's a pattern we see year after year.
So that leads to the big question, right? Why? Why does this keep happening? How can smart people consistently get returns that are so much worse than the very funds they're invested in? Well, we're about to break down exactly why, using the last 2 years as our evidence.
So here's our game plan for this postmortem. We're going to start with what I'm calling the ghost dip of 2024. Then we'll look at the market's wild pivot in 2025. After that, we'll put a name to the problem, the behavior gap. Then we'll compare willpower versus protocol, and we'll wrap it all up with a data-driven verdict for 2026.
First up, the ghost dip. This was a really expensive psychological trap that so many people fell into. You know the feeling. You're sitting on the sidelines, holding cash, totally convinced that a big market correction is just around the corner, but it just never shows up.
So while so many investors were patiently waiting for that dip, the S&P 500 went ahead and delivered a total return of over 23%. That is the first painful layer of the cost of hesitation, a huge, potentially life-changing gain that was just completely missed by people trying to play it safe.
And the cuss didn't stop there. It actually compounded. In 2025, the market added another 16+% on top of that. So being on the sidelines didn't just mean missing one good year. It meant missing a historic back-to-back run. Suddenly, that safe choice of holding cash turned out to be an incredibly expensive decision.
You know, this just brilliantly illustrates that timeless piece of wisdom from Benjamin Graham. The hard numbers from 2024 and 2025 are a pretty brutal lesson in just how much it can cost you to try and be clever and time the market perfectly.
So let's move to our next section, because the real reason market timing is so pointless is that the entire personality of the market, the things that are driving it, can change on a dime. And that makes whatever you predicted yesterday completely useless. And this is exactly why timing fails. I mean, just look at 2025. It was like two completely different worlds packed into a single year. It started with tariff turbulence. The playbook seemed obvious. Play defense, right? You've got policy shifts, a hawkish Fed. But then the script completely flipped. The second half of the year became the calm rally, this weirdly quiet period where the S&P just ground higher and higher for 119 days without any real pullback. The rules of the game changed midstream, and anyone playing by the old rules got left in the dust.
Now, this whole problem, this gap between how an investment performs and how the investor holding it performs, it isn't some big mystery. It's actually a known, measurable issue in finance.
It's called the behavior gap. And this is so crucial to understand. This isn't an intelligence problem, it's a psychology problem. It is the measurable financial cost of making decisions based on fear or greed or just hesitation, instead of following a clear, unemotional process.
And that is exactly why we are doing this deep dive. The entire purpose of this analysis is to arm you with knowledge, because really, the only way to close your own behavior gap is to build a process that shields you from making those gut-level emotional decisions with your money.
So this brings us right to the solution. Let's draw a really sharp line between how most people approach the market and how professional, institutional systems are built to win over the long haul.
On one side, you have willpower. This is the classic retail mindset, right? You save up cash, you watch the headlines, and you try to use your own judgment to manually buy that perfect dip. But on the other side, you have protocol. This is the institutional system. It's unemotional, it's automated code that just buys on a set schedule, no matter how scary the news looks or how the market feels that day.
And I've seen this difference up close. My old job, I was a fintech engineer at a multi-billion-dollar hedge fund. And our primary role wasn't trying to predict the market. It was to build these automated protocols. The entire goal of our work was to remove the human in the loop, to systematically engineer our own emotions out of the process, and you guessed it, eliminate the behavior gap.
Okay, so let's bring all of this home. How do we apply these lessons right now, here in 2026, to make a smart, data-driven decision for the rest of the year? Especially when, let's be honest, the market feels dangerously high.
First, let's look at the bull case. A lot of professional forecasts are calling for the S&P 500 to potentially hit 7,800 by the end of this year. So that suggests that even after this historic run, there could still be some serious upside left.
But, and this is the big one, this is the part that makes your stomach churn, market valuations right now are in the 93rd percentile, historically. They are objectively expensive. And this is the exact kind of data point that triggers that wait for a dip instinct. It creates the perfect emotional trap. So what does the data tell us to do?
This slide resolves all that tension with pure math. A 20-year backtest reveals a pretty stunning truth. Let's say you had the worst possible timing. You only bought at the absolute peak of the market every single year. You still would have earned an annual return over 10.5%. Now compare that to the cautious investor, the one who sat on the sidelines and just happened to miss the 10 best days. Their return got cut almost in half, down to just 5.33%. The data is undeniable. The risk of being out of the market has historically been far, far greater than the risk of buying in at a peak.
And so we end with a question for you to really think about. Is your own investment strategy based on a spreadsheet and your feelings, something that's vulnerable to your own hesitation and emotions? Or is it a hard-coded protocol that runs on its own, protecting you from your own worst instincts? The data from the last 2 years suggests the answer to that question is going to determine your financial outcome.